Hi, welcome to 4.04, the Stock Market 1. This is the start of slide 12. Which companies trade stock? There are two broad types of companies, and only one can trade stocks. A private company does not trade stock in the public market. Private companies are privately owned. Because their owners do not share their profits with the public, they do not disclose their finances or operations to the public or trade on a public stock exchange. The private owners are fully responsible for the company. If a private company goes bankrupt, creditors can come after the owners and take their personal belongings, such as houses, cars, and real estate. A public company does issue stocks. The company's stocks are listed in the public market, and its operations are under public scrutiny. It must report its financial information to investors, as well as to the Securities and Exchange Commission, SEC, and it has to meet strict SEC standards for publicly traded stocks. A public company sets up business as a corporation. Corporations are legal entities that are separate and distinct from the owners. Corporations have their own rights and liabilities. If a corporation goes bankrupt, the owners are not held personally responsible for any debts. Owners are liable only for the amount of money they invested into the corporation. Which companies trade stock? Here's another chance for a quick check. What characteristics match which type of company? And as always, or as usual, go ahead and do that on your own. Different types of stocks. Stocks come in one of two main types, common stock and preferred stock. The majority of stocks are issued as common stock. Preferred stockholders have a better claim on the company's assets and earnings than common stockholders. They usually get fixed, regular dividends, while common stockholders get variable dividends. Also, if the company goes bankrupt, creditors are paid off first, then preferred stockholders, then common stockholders. Preferred stock is, therefore, generally a safer investment than common stock. This safety comes at a price, however. Preferred stock cannot increase in value as rapidly as common stock because of the fixed dividends. Common stock has less security than preferred stock, but it also has greater potential for reward. Another way of classifying stocks is by the size of the company that issues them. A company's size is measured by its market capitalization. For example, if a company has 1 million shares that trade at $10 a share, its market capitalization is $10 million. Companies are ranked according to their market capitalization, size. Key features of the stock market. Although there are many places where stocks are traded, the stock market is not only a physical place. In fact, the stock market is a global electronic network that links buyers and sellers and enables the exchange of shares. The stock market is one of the most important features of a market economy. It gives businesses access to capital, and it gives investors access to business ownership with the potential of making a profit. The stock market is very dynamic. It is constantly changing because people are always buying and selling stocks based on the state of the economy and numerous other factors. Just like the entire economy, the stock market cycles between phases of expansion and contraction. If the swings go too wide in either direction, they are known on the high end as a bubble and on the low end as a crash. Bubbles and crashes usually go together. Bubbles occur when demand for stock rises so high that it drives prices above real value. Sooner or later, the prices drop and the stocks crash. When the entire stock market crashes all at once, it creates conditions that are hard to reverse and can last for years. A massive stock market crash helped cause the Great Depression of the 1930s. Another crash that occurred in 2007 and 2008 helped lead what has been called the Great Recession. Stock market, the main types. There are two types of stock markets, the primary market and the secondary market. Primary markets are markets in which companies first issue shares in an IPO. Secondary markets are markets in which stockholders trade previously issued stocks. When people talk about the stock market, they usually refer to the secondary market, where the daily buying and selling of a company's stock does not directly involve the company. These stocks are traded on a variety of markets, both big and small. The stock market. Main types. There are a lot of misunderstandings about the stock market. You can clear up two of the biggest misconceptions here. Click the blue triangle to begin. Use the arrows to advance or review the slides. And you can do that on your own again. Taking stock of stocks. You have learned that stocks, in the broad sense, are supplies of commodities. People have been buying shares of ownership in stocks for several thousand years. Today, people buy shares of ownership in corporations. Shareholders invest in stocks with the hopes of making a profit, either in the form of dividends or a capital gain. Company owners issue stock to raise money without having to go into debt. There are risks on both sides. Investors can lose their investments, and public companies face more scrutiny by the government and pressure to do well from investors. The stock market is the global marketplace that connects stock buyers and sellers and facilitates the trading of shares between the two. The stock market is very dynamic with constant trading. Prices swing up and down. Usually, the swings are not too wide, but sometimes market trends cause the market to become unstable. Bubbles result from too much buying and overvalued prices, while crashes result from panic and too much selling. Investors spend a lot of time trying to figure out which way stock prices will go, but there is no surefire way to forecast stock prices. The only certainty is that stock prices will change. Why do stock prices go up and down? The law of supply and demand has a lot to do with it. The value of a stock, or any commodity, can also be the result of how consumers and investors view a company. But investors who focus on every little shift in the market are bound to become confused and discouraged. Wise investors try to pay attention to long-term trends in the market. Learn about stock exchanges and look at how people acquire and trade stocks. You will also explore the theories that stock market analysts use to try to understand and predict stock price fluctuations. You will wrap up the lesson by looking at different types of investors and investing styles. Stock exchanges. A stock exchange is where buyers and sellers of stocks negotiate and agree on a price. Some stock exchanges are physical places, while others are virtual or digital markets. A physical stock exchange is actually an auction market. As with any auction, the final selling price is a matter of bids being made and accepted. Much of the trading occurs on the floor of the exchange, where each listed stock trades in a certain spot. Exchange members interested in buying or selling on a particular stock on behalf of investors gather at this spot, where a specialist broker acts as an auctioneer to bring buyers and sellers together. A stock exchange is often a frenzied place. For instance, the New York Stock Exchange, the world's largest, is a seemingly chaotic mass of people buying and selling. Also known as the Big Board, the New York Stock Exchange is home to the largest companies in the United States. A virtual stock exchange is called an over-the-counter market, where representatives of buyers and sellers meet through their computers. These markets have no central location or floor brokers. Transactions are handled completely electronically. The NASDAQ is the most popular of the virtual stock exchanges and is the second largest stock exchange in the world. The NASDAQ, which originally stood for National Association of Securities Dealers Automated Quotations, is home to several technology companies. How do you buy stocks? Although it is easy to buy stocks directly in an over-the-counter market, many investors prefer to use a broker to purchase stock. Brokers handle the buying and selling of stocks for investors. A broker can be a person operating individually, but many brokers work for large brokerage firms, which are businesses that employ many brokers at once and represent a large number of investors. Brokers and brokerage firms make money by charging customers a commission for each transaction. Most brokers also require a minimum deposit to open an account. There are two main types of brokers, full service brokers and discount brokers. A full service broker is a traditional broker who gives advice about investments and manages the client's account. The service is personalized, but it can be expensive. Today, with the proliferation of the internet and the ease of making trades, many investors use a discount broker. Discount brokers don't offer much personal attention, but the service is much less expensive. Many stock market investors try to keep broker fees low because fees can erode the profits from investing. Discount brokers are a good choice for investors who have less money to spend and want to do their own research. They charge less per trade and require smaller minimum deposits. Online trading helps cut down on brokerage costs for all investors by reducing the labor involved in making stock trades. This is going to be the end of this session. We will start next with 4.04 and finish up the stock market 1 on slide 23. Please let me know if you have any questions or concerns.